recipes for technical trading success in Cook's Kitchen.
All right, how has ChatGPT impacted the stock market algos who tend to rule the market? We're going to talk about that. Speaking of ChatGPT, I just want to alert you to some of the things we've done here. If you want to get my free report on ChatGPT, I did on March 20th. I published this report and I recommended NVIDIA when you could still buy it at $275. I also recommended a stock that a lot of people don't know about, and that's Synopsys. Synopsys is part of only one of two companies, along with Cadence Design Systems. These are the electronic design automation, EDA, or system design enablement, SDE. Those are the acronyms they go by, that help semiconductor manufacturers design their chips with software. We've owned Cadence for a long time. I recommended Synopsys, back like in March 20, so you could still have bought it under 375, and just like NVIDIA launched. Like NVIDIA was basically the Falcon Heavy rocket that took off, and it takes its partners like Cadence. NVIDIA is a big customer for Cadence, which Jensen Huang has featured in his videos, and it took Synopsys higher. So those are some of the things. So if you want to get a copy of that report and just understand what was true before ChatGPT in AI, and then how everything is just being accelerated, just email ultimate@zacks.com and ask for the ChatGPT report I wrote in March. A lot of good stuff in there, still relevant, and some of the picks are too. And tell them Cooker sent you. Ultimate@zacks.com. All right, so let's get into this. So we're going to talk about trading algos, but I'm going to show you a quick video by a rocket scientist, and he'll be a little bit hard to hear. He's, I believe, he's British, and he's soft-spoken, smart guy. I will annotate his words for you right after we listen to this. So let me make sure I have the sound on here.
The advent of ChatGPT is of great interest to financial markets and particularly machine learning in financial markets. It's rather different to what we do at IQ, in that it is primarily what's known as a natural language. Where I see that being important in financial markets is largely in what is known as sentiment analysis. We decided to focus our efforts entirely upon those market data: prices, volumes, trades, macroeconomic indicators. Because we're monitoring those on relatively short timescales and we are performing robust statistical analysis of those, we can access those shifts in sentiment, but from the market data themselves, rather than from the human expressions of those sentiments that would be accessible to natural language processing machine learning models. I don't believe it's going to impact the business that we're engaged in, which is deriving that market sentiment directly from the market data themselves, where ultimately it has to be expressed. And provided one can discover that expression quickly enough from those data, which we can, then we are insulated from what's going on in the natural language processing machine learning.
All right, I hope you enjoyed that. If you want to watch the video again yourself, just follow this gentleman, Mahmood Noorani, and at quant_invest. I believe he's a member of the IQ firm, so that's why he posted this. And I will break it down for you, but that's where you can watch it again. So who is Professor Michael Hobson? A true rocket scientist. He's a professor of astrophysics in the Cavendish Astrophysics Group of the Department of Physics at the University of Cambridge. He's published over 400 research papers and 8 textbooks. Okay, so this guy knows his stuff. His intellectual property has been used at the European Space Agency to get the Juno probe to Jupiter and in the Large Hadron Collider at CERN to discover the Higgs boson, or God particle. So obviously, this guy loves science, math, physics, astrophysics, and working with large, noisy, opaque data sets. I mean, this is why, for 20 years, smart Wall Street firms like Renaissance Technologies have hired your physicists, your rocket scientists, because these guys know how to model data. So he's a academic partner for IQ. I'll just explain real quick. IQ is they claim to bring this quantitative intelligence to retail investors. And I'll go over again how he says he does this. Let's go back to my slide deck here. Just some background here, why I feel I'm slightly qualified to talk about this. I traded against the first algos in currencies in the year 2000. Actually, the first algo that we discovered when I was trading on Globex after the introduction of the euro, and it was Monroe Trout, a famous market wizard. At the time we called him the robo trader, because I could tell as I made markets in currencies on Globex against the cash market and did the arbitrage, I could tell who the counterparty was that hit my bid or paid my offer, and there was this sequence of patterns that we started to see where things would happen automatically. Certain triggers at prices or price action and volume. And he was doing 100 lots with me. So that was when I got really interested in what is the potential of algorithms in markets and the stock market. And so here are some of the big things. This is not everything you need to know, but why do the algos rule? Why do they win in the stock market? Number one, rules-based execution means zero emotional decisions. Number two, speed of execution. That creates outsized alpha where they're selling more of the highs and buying more of the lows. Now, I list these four things here. You could almost multiply them by each other, because once they have rules-based execution with no emotion, and then they have speed, that's a multiplier. Number three, automated risk management. Another big multiplier when they can stop and reverse on a dime, like a figure skater. I chose figure skaters. My daughter's a figure skater, and she does remarkable things at 11 years old that I can't even imagine. So, that's about speed and stop and reverse. Macro models, when they can take all the data, not just of price, volume, and trades, but of what's going on in the economy or a given stock or industry, and incorporate it into their models, and also use daily news and data, they've got a huge advantage. So all these things multiplied. This is why algos win in the stock market. All right. Not only does it make them super efficient, but it makes markets more efficient when all the information gets digested quickly. Now, we all know the efficient market hypothesis is, we threw that out the window 50 years ago. But markets have become more efficient because there is a faster discounting. So in the aggregate, algos make markets more efficient, but they're still a fly in the ointment. So number one, we just have to understand how institutions managing trillions have war desks of data crunching power. They've got the rocket scientists and all their surrogates and helpers, and that makes the markets discount macro faster. Number two, it's hard to beat their timing. I mean, in some ways, you're like, if I'm a trader and if you are an active trader, the grind, and how you get beat up, and you got a good position and you get whipsawed out of it. And the algos don't care, right? Because they can move with no emotion and just precision buying and selling rules. And they're also battling each other. So sometimes you're also getting caught if you're an active trader, you're getting caught in the skirmish between multi-million-dollar funds firing at each other without emotion. So, and I mentioned Renaissance Technologies. Jim Simons, the mathematician, I mean, he created the model basically for this in the 80s of, hey, let's hire the rocket scientists because they know how to crunch data and model it and do the stats and probability that we need to create active algorithmic programs that run automatically. And number three, this is the fly in the ointment. Every now and then, the trend equilibrium fails, and the algos can't keep pushing the way they wanted to, or can't keep in the same consolidation patterns that they wanted to, whether it's due to randomness or exhaustion, and markets can drop into big value zones. And that's where long-term investors make some bank. So always keep that in mind on the big dips. In other words, I used to say the machines eat each other. They're battling each other, they eat each other, and markets break down, and you get those big sell-offs where some of the algos are pushing it, and they're gonna make huge money. Others are getting hurt. They're forcing out hedge funds and mutual funds, and then those are the buying opportunities. Okay, so what I did here is I transcribed the text of Michael Hobson, the rocket scientist we just talked to, the astrophysicist, or we just heard from. And so here it is in the video. So you can stop the video, and this is basically the 98% accurate transcript of what he said in that minute and a half video. So he's talking about the recent advent of ChatGPT, and he wants to explain what does it. There are firms out there who may be exploring how can we use ChatGPT to analyze the sentiment and investor consumer behavior, reactions and emotions, and then model that to make trades. He's like, we don't do that. That's the natural language processing model is great. He said, but they decided long ago that they're going to do their sentiment analysis from hard data. What is hard data to him? Prices, volumes, trades, macro indicators, and they can do it in short time scales. So he says that leads to they're performing robust, stat analysis of all that data, and then from that they can derive the shifts in sentiment. So they don't need ChatGPT to do it for them. Or any level of ChatGPT sentiment analysis. And so he reiterates he's getting the human expressions of sentiment. He's deriving that from data. And some people will try and do it with large language models. They already had their models before that based on hard data. So he says it's not going to affect the business they're in for IQ, and so they feel they're insulated from what's going on in natural language processing and machine learning models. So it's a great perspective. Now, whether he's right or not, or you agree with him, or you're going to become a customer, it doesn't matter. I'm trying to introduce you to this conversation that the engineers and the rocket scientists and the fund managers at Renaissance Technologies are having with each other. And I use Renaissance as an example. Michael is not associated with them, but he is if Renaissance hired Michael, he would be a senior advisor in terms of the engineering that goes on there. All right, so I think I basically introduced all I wanted to for that, and just to give you an idea of where the battle is going. There are still opportunities for the small trader. You're still just swimming in an ocean you can't control. As I always say, you're just a surfer, never looking, never getting angry or upset. You're just looking for the next wave, right? You never blame or hate the ocean for being itself. You're just taking the waves that are given to you, and regardless of what is driving it, there will always be randomness and chaos as even the algos battle each other. All right, so pay attention to what's going on. And I just recommended Cadence again the other day. Cadence is, so I'm showing you synopsis here, but Cadence is basically these two companies are a duopoly in electronic design automation and system design enablement, basically the software brains for chip manufacture. So Cadence just has a new partnership with Taiwan Semiconductor. They're a major beneficiary of NVIDIA business, and I still think you can buy Cadence here. Looking like it wants to go higher, just like you got Synopsys putting in a little bit of a bull flag, and another flag here for Cadence. All right, we'll talk to you soon.